COVID. And obviously, as a result of COVID and the lockdowns, many businesses that would not have normally been financially distressed have suddenly gone into financial distress. And the difficulty is when a company is in financial distress or a business is in financial distress, what should one do about it? And I think, practically speaking, and what I've actually witnessed, say in these last 17 months since COVID started, is that people, and especially family businesses that have been in existence for years, don't seem to face reality, and they face the problem too late. And I think that one would get a better result if people would realize that there might be a problem going into the future and take advice immediately. And when I say take advice, I don't mean take advice only from an attorney. I would start by taking advice from the accountant that has dealt with a business for years, and then take it from there. And it's not all doom and gloom if you get to the problem early. But unfortunately, as I said, people wait until the last minute when it's too late. Now, one has different options when you are financially distressed. And first of all, I would say this: it is certainly better, if it can be achieved, to avoid a formal legal process. In other words, before one considers whether to go into business rescue or do a formal offer a compromise with creditors through the courts or go into liquidation, one should analyze the business and see if it's possible to reach an agreement with all your creditors. It's far better to do that than to immediately embark on a formal legal process. Now, 9 times out of 10, when you talk about financial distress, you'll find that there's a bank or many banks involved. So what should one do in a situation like this when you want to avoid a formal legal process? I would say you start by getting your accountant to analyze your business, bring all the accounts up to date, and to see where you actually are. And then, if you foresee there's going to be a problem, start by approaching the banks, or for that matter, some of the major creditors. Now, with financial distress, it's not, one boot fits all. I mean, there are different things that you can create to deal with each and every situation. Now, before I even start to give you all the different alternatives that you can look at, I would say that the most important thing when you experience any form of financial distress is to analyze your business, as I've said, and to do a pre-assessment of the business. And this is where I'd like to bring in Lance, because Lance is often involved where businesses call him in because they foresee there's going to be a problem, and they ask him to analyze the business. In fact, Lance is also engaged by many of the banks who, when a client approaches them, would like to see what the business is all about, what the difficulties are in the business. And it's very common for them to want an independent person to analyze the client's business. And for that reason, banks call in Lance. And why they call in Lance is to do a pre-assessment of the business. In other words, although the business might be in financial distress or will become financially distressed in the near future, people want to know, is there a possibility of this business continuing? And if so, how much money will you need to do it? And also to ascertain if there's going to be a legal process, if it's not possible to settle with creditors, how that legal process should occur. Must it be a liquidation because there's no possibility of a business rescue? If there is a business rescue, the cost implications. So I'd like Lance just to start with telling you what a pre-assessment really is and how one should go about that before we even start with going for any formal legal process or approaching any creditors or banks. Lance, if you can just assist me there.
Sure. Thanks, Paul. I completely agree. So in terms of a pre-assessment, or what we also call it an independent business review or an IBR, is really what Paul was referring to when the banks, law firms engage with us to do a very high level, very quick mandate, coming into the company completely independent, completely fresh of the matter, and taking an independent high level view of the company. And what that really entails is analyzing the business, the current performance, historic performance, and just understanding, where the financial distress or potential distress currently sits. Is it factors relating to inside the business? Is it external factors? And what we then do, to Paul's point, is I think while we specialize in business rescue, absolutely what we've seen, getting there earlier and timing is absolutely critical in these matters. Often we just see companies coming way too late to even stand a chance of restructuring the company informally. So timing is, I cannot stress timing enough. So when you do have that time to have a look, a 2-week quick deep dive into the company, and you really analyze the options that the company has available to them. So first prize, to Paul's already mentioned, is absolutely look at, can the company be restructured informally? Can you engage with the banks, the major creditors, and try and restructure the business in an informal matter? I'll touch on the consequences or the unintended consequences of a business rescue. I think a lot of people feel that business rescue is the silver bullet and it's going to save everything and everything's going to be okay, and you're protected from a legal moratorium. But I think there does come a time where there are consequences of pressing that button, and I'll touch on that, and I'm sure Paul will touch on that a bit later. So in terms of an IBR, an independent business review, what we typically look at is, what is the company currently achieving? What is its current performance? And is it sustainable going forward in its current state? What sort of restructure would need to take place? And we essentially compare that to what a potential business rescue would look like, and what ultimately the worst case scenario, what a liquidation would look like. And it's really giving the directors of the company an independent view of what each scenarios look like. And I think it's important because it really focuses management. It focuses management to see what essentially are the bookends of the business. Best case scenario, what we have found in informal is generally the best way to go, and liquidation is ultimately obviously the end of the business. And that's the sort of thing that we will include in a business, in an independent business review. Other items, and Paul, I don't know, I can jump into what we'd look at from looking at a potential business rescue. I don't know if you want to touch in more of the legal side now, but I'm happy to go into what we would look at in the independent business review within a business rescue situation as well.
Thanks, Lance. I think what we should do is I should possibly give everyone the different options. And then later, if you could assist me with dealing with a business rescue and what the pitfalls are and what you've got to have in place before you even contemplate a business rescue.
Yeah, absolutely.
Because I think what happens is when people don't know the process, they're always told, put it into business rescue. That will now keep creditors at bay and it takes the pressure off. But what they don't realize is that you need money in a business rescue. So I'll go through all of that. And then later on, I'd like you to deal with what you've got to analyze for the cash flow in a business rescue, because as we all know, that changes dramatically. Your cash flow in a business rescue is very different to what your cash flow is if you're not in business rescue. So to simplify the issue, let's say that you as a business, or if you're operating through a company, are now concerned that you are financially distressed or that you may become financially distressed. The Companies Act sets out the meaning of financially distressed. And that's, the Act states that financially distressed means that if you are unable to pay your debts or are insolvent, or you believe that within the ensuing 6 months you will not be able to pay your debts or will become insolvent, as a director, you should take certain steps. Otherwise, if you don't inform creditors that you're unable to pay your debts and meet your commitments, you can be personally liable. And this is in terms of Section 129(7) of the Companies Act, which sets out a procedure where you're supposed to give creditors notice in writing why you're not going to apply for business rescue if you are financially distressed. That in itself, to me, creates another problem, because can you imagine when creditors get this letter that you might not, you're not going into business rescue, but you're financially distressed, they'll never supply you. So that in itself could cause a problem. Now, if we've come to the conclusion that you're now financially distressed, the options available to you, and I'll go into this in more detail than I did before, is obviously to engage with all your creditors, start off with the banks, but you have to realize that for this process to work on an informal basis, after speaking to all of these creditors, you have to have all of them support you. You need 100% of all creditors agreeing to support you, to give you time, to wait for payments, whatever. By approaching them, it's obviously an act of insolvency, entitling any creditor to rush to court and apply for liquidation. So the informal process can be dangerous. So you've got to make sure that you'll be able to get all of your creditors supported. If that is not possible, what do you have to do next? What are the options available if you can't proceed on an informal basis because you can't get the support of 100% of your creditors? You've then got to consider either a business rescue or a liquidation. Now, business rescue, a lot of people feel is the magic word because at least it keeps your creditors at bay. But let's just analyze what you've got to have in place to even contemplate a business rescue. Before you apply for business rescue as a company, you've got to show that the company's in financial distress, which is pretty easy, and there's a reasonable prospect of rescuing the company. Now, that is a very important factor. Reasonable prospect of rescuing the company. Now, that does not mean that by rescuing the company, it only means that the company will continue and the business will continue as a going concern in the future. It can also mean that there's a reasonable prospect of rescuing the company if you can show that a business rescue will give creditors a higher dividend than the dividend they would get on a liquidation. And that can be because of a multitude of factors. For example, the business rescue costs could be less than a liquidator's costs. It might be easier to dispose of the assets in a business rescue rather than in a forced sale in a liquidation. So there are ways to motivate the second part of a business rescue, and we divide a business rescue into a part A or a part B. Part A being the business that continues to trade, and part B when you're realizing the assets and there's a wind down procedure, but as a result thereof, you are able to give creditors a higher dividend than they would get on a liquidation. The big problem with a business rescue is you have to have what they call post-commencement finance available. Now, post-commencement finance means that you'll need money to be able to continue the business. And even if you don't continue the business and you wind down the business, you've got to remember that in a business rescue, unlike a liquidation, your staff continue to be employed and they have to be paid. Now, you can imagine a situation where you're sitting with over 1,000 employees and you haven't got money to pay them. What can happen? Whereas it's very different on a liquidation when you're dealing with employees, because you don't have to have the money to pay employees in a liquidation. The liquidator can automatically suspend contracts of employment. Now, when we're dealing with the business rescue here, this is where people like Lawrence are vital, because before any company should consider business rescue, they should take into account what the business rescue cash flow is going to look like. And this is where you need a pre-assessment of the business beforehand. Now, to apply for business rescue is a simple process. It's done in terms of Section 129 of the Companies Act, where the board of directors just has to pass a resolution showing that the company is in financial distress and there's a reasonable prospect. You've got to prepare a sworn affidavit setting out the facts, and you lodge those documents with the CRPC, which is the Commission for Intellectual Property and Companies. They stamp the resolution, and once the resolution is stamped, the company is automatically in business rescue. The company then, within 5 days, has to nominate a business rescue practitioner. You usually nominate the business rescue practitioner up front. And if the business rescue practitioner that you nominate is licensed by the CRPC, the business rescue practitioner gets appointed and you can start the business rescue process. However, if there's an intervening liquidation, in other words, if there's a liquidation that's been launched and the company wants to go into business rescue, then you can't go through the 129 route by the director signing the resolution and the sworn statement. You'll have to go to court with an application and demonstrate to the court that a business rescue is far better than a liquidation. And that process is much more costly, and you'll have to prove that there's a reasonable prospect of business rescue and it's better than a liquidation. Now, why you need to analyze the business before you apply for business rescue is extremely important, because you've got to know that what your cash flow is going to look like in a business rescue environment, and whether you have the cash available. It's no use going into business rescue and a few days later or a few weeks later realizing that you're not going to raise the money. You're not going to raise the post-commencement finance, because that is going to only cause a liquidation with a loss of goodwill and everything, and you could land up in a worse position than if you first applied for liquidation. And this is why it's so important and vital up front, before you even apply for business rescue, to go and consult, speak to your major creditors, see if they are prepared to support a business rescue, because also for a business rescue to be successful, you need to have the business rescue practitioner put up a plan to creditors. Now, that plan has to be supported by 75% of the creditors in value. In a business rescue, all creditors vote in the same class. There's only one class: secured creditors, preferent and concurrent, all vote together. And at least 50% of those creditors have to be independent creditors. They can't be, for example, I'll just simplify it, have loan account claims as shareholders and expect those votes to be more important than the votes of independent creditors. Now, I think at this point, I'd like Lance just to point out to you all what sort of cash flow you're looking at in a business rescue. Because remember, when you're not in business rescue and you're trading normally, your suppliers don't have a problem. They supply you in the ordinary course. You can pay over a period of time, 30, 60, or 90 days. But in a business rescue, creditors are nervous. Your suppliers usually want money up front before they'll supply you. And also in a business rescue, if creditors are going to lose money, a lot of them might not be prepared to supply you any further. And then also critical suppliers who are not going to be paid because of the business rescue, like, for example, the logistics companies will say to you, well, unless you pay my old debt, I'm not going to continue with the services. So I'd just like Lance to tell you and give you an insight as to what you've got to look for in a business rescue cash flow.
Thanks, Paul. But yeah, absolutely. Just to reiterate what Paul has said, is, you know, the major benefit, I'm sure, if anyone has ever heard of business rescue, I think the major benefit the first thing everyone hears is a legal moratorium on all debts that gives obviously the company some breathing space to implement a restructure and a business rescue. I think the problem that comes with that, it's not as easy as just you've got a legal moratorium and creditors are going to continue to supply you. We see it on every single business rescue matter. The strain on cash flow becomes even more apparent the minute you go into business rescue. As Paul mentioned, suppliers who are willing to continue supplying you change terms immediately. You're looking at COD at best 7 days. As an example, on Edcon, Piers and myself are the practitioners of Edcon Limited. We saw that with most of the suppliers that continued supplying us through the business rescue process, we got 7 to 14 day terms. So you really, in terms of this pre-assessment that we referred to a little bit earlier, is understanding what a cash flow is going to look like in the event that you go into business rescue. Are you going to need to change suppliers in the event of suppliers no longer supplying you? Security companies, logistic companies, and other cleaning services and other providers like that, potentially charging high rates because they know there's a potential that there's not going to be business going forward. Another critical part of the cash flow is the war chest that also Paul spoke to around, wrong terminology, but blackmail creditors in a sense, where, you know, you've got an internet provider or someone who's absolutely critical to the business, that the business cannot operate without their services, that you would have to potentially look at settling pre-commencement debt, or even looking at entering an arrangement for a post-commencement arrangement where there is some sort of recovery. So I think, and that ultimately needs to be assessed from the practitioner. While you are treating a creditor differently, it's ultimately would be for the benefit of all creditors, because the business continues, hopefully you make margin, and there's a better recovery for all creditors. So there is a massive strain on the cash flow. Paul rightly mentioned the impact of staff in a business rescue as opposed to a liquidation. All rights in terms of the employment contracts remain. Full retrenchment packages are due and payable. There was, I'm not sure if you were, about a year and a half ago, a judgment that came out from off the back of the SAA matter, where the unions took the practitioners to court around a retrenchment process. And what the courts found was the practitioners cannot start a retrenchment process until such time that you have published the plan. And what that does, and I'm not in favor of any retrenchments, but unfortunately, sometimes to cut the burn and to cut the loss, we often see from a head office perspective, or whatever the case is, there are excess staff, and to reduce costs, you do have to go that road. What has now happened with the SAA judgment is you can only start a retrenchment process once the business rescue plan has been published. So the issue there is, if you have identified that a retrenchment needs to take place, you're already 1 month behind the game in terms of starting the retrenchment process. So it is very costly from a staffing perspective as well post this judgment. I think a further, and it's difficult to always project and forecast prior to business rescue, you get hit with it the minute you go into business rescue, but it is a very litigious environment. Creditors are aggrieved, there's issues all over the show, and I think you will need a war chest for legal costs to defend legal matters. It is, like I said, very, very litigious. So I think other than what Paul has mentioned and I've raised, I can't think of anything else around a cash flow environment, but that is certainly something that these are the aspects that you need to include in a forecast, which ultimately brings you to timing is important, but I think the concept of post-commencement finance is absolutely critical. So I think when you come up with a cash flow for a business rescue, either pre or immediately thereafter, you are going to need post-commencement funding. And that typically comes from banks. I think shareholders have reached the point where they either don't have the funds, don't have the appetite, and have reached the last, they've come to an end with in terms of where do they find the funding to try restructure informally. So I think generally from a post-commencement point of view, you're going to have to look at creditors, you're going to have to look at banks to provide you those funding, because funding also, post-commencement funding is not necessarily only monetary, it can be providing further terms, which you'll ultimately need to pay back. Again, an example on EdCon, with a massive rental bill, we entered immediately into an arrangement with all the landlords where we would only pay a certain percentage of turnover and catch up the payment from essentially the 94% or whatever the shortfall was when we ultimately sold the business or turned the business around. So that was a form of post-commencement funding in EdCon, where it wasn't actual cash provided, but it was essentially providing us additional terms to give us that breathing room to implement the plan. I think other things in terms of the analysis, Paul, I think I'm just going to touch on very briefly outside of the cash flow, just things to be aware of from a business rescue point of view. I think that the change in the supplier terms we've mentioned, it is a big concern. There's additional negative publicity, so it still has a stigma attached to it. Business rescue, although it's been around for around 10 years now, there is a negative connotation, and unfortunately when you're looking to realize assets or sell the business, there is an impact on the business, knowing that it isn't a formal process. And then obviously when it comes to entities within a group, I think it's also important to know what the impact could be on group companies in the event of an act of insolvency. So those are just some of the things also to consider when you're considering a business rescue. You don't want a domino effect where there's breaches and covenants breached in terms of group companies within, I guess, the broader group. In terms of, and then Paul, I'm going to hand over to you, just some critical success factors, just that we look at to ensure, just from past experience, that to have these in place, it really goes a long way in ensuring that we get a successful business rescue, either a part A, as Paul mentioned, or a part B. I think post-commencement we've touched on. The retention of key staff is also very, very important. With EdCon, we were able to identify those staff, and I think it shows through the process what time before the business rescue, even if it's a week, even if it's 2 weeks, being able to have a discussion with management, have a discussion with major stakeholders to understand their support and their buy-in into the process, that the minute you press the button from a business rescue point of view, you at least have some sort of advantage. I think it's pretty intense the minute you go into business rescue. It's very fast. It's meant to be a fast process. I know the tail of a business rescue does last long, but the initial 3 months where all the action is, you need to have your wits about you and ensure that you have as many bases covered as possible. And that's why the time before is critical. So I think from a retention point of view, absolutely look at retaining staff, ensuring there's a strong management team, and discussing with creditors, in the event that it would go into a formal process, would there be a possibility of a support through the process? So those are just some of the things I can think of right now that we've looked at through experience of making the business rescue a little bit more successful.
Thanks, Lance. When you're dealing with a distress situation, the most difficult time that I'd say a professional, and more particularly an attorney, has is to try and advise people who've run a family business for years that they need to consider a liquidation or a business rescue, because the psychological effect and the damage that they feel this will cause and the emotions sometimes result in a proper rationale disappearing. And it's more of how is this going to be taken in the community? What should I do? Here I've always been someone who people have looked up to. Now the business is going to collapse. And this sometimes also motivates a decision rather to go into business rescue than liquidation, because business rescue is less of a stigma. Now, as far as I'm concerned, and I've always said it, liquidation is a 7-day wonder. When you go into liquidation, the first day is a shocker. It's a complete change. But it's amazing how when time goes on, people forget about what actually happened. And even clients that I've now spoken to that had to apply for liquidation have said that it is better. They were very upset at the beginning, but obviously now they realize that liquidation was the right thing to do. Another thing that you've got to take into account here is that you can't keep a business going in the hope that things are going to turn around. Sometimes the business itself is bad and cannot be rescued. The business has changed. The product might have been good 10 years ago, but is not good now. So the whole reason for continuing with a business has disappeared. You'll never get the business right, but people will not accept that. Now, once you have done a pre-assessment and you've come to the conclusion that you're not going to find the money for a business rescue, you're not going to be able to continue employing your staff, there's no likelihood of someone putting up funds, and in fact, there's no likelihood of anyone going to buy the business, and if they're going to buy the business, it's going to be at a very low figure, then you might well have to consider going into liquidation. Now, liquidation is not the end of the world. With a liquidation, it's different to a business rescue. You've got to apply to court. There's no simple procedure. And when the court grants the liquidation order, a liquidator gets appointed, and the liquidator will decide whether to continue with the business or try and sell the business. Before you go into liquidation, just let me tell you something else here, is that if, for argument's sake, and as I said, no shoe or boot fits all, if there's a situation where you've got the majority of creditors supporting a business rescue, but you've got a few difficult creditors, but those few difficult creditors are in the minority, and you'll still be able to get the statutory majority of creditors to have a plan passed, then you can use business rescue for what people term a pre-pack. In other words, there is a good chance of the business being rescued. Creditors are in favor. You'll get the support in the post-commencement finance to continue with the business rescue process until a plan can be adopted. And then to bind those minority creditors that can't change the outcome of the plan, you can use a business rescue. And that does happen. But if you go into liquidation, and please just in the short space of time available, just an hour to go through all these different legal processes, it's quite difficult. But I just want to give you an overview of all the different legal concepts that are available if you are in financial distress. If you go into liquidation, and there is a possibility of then rescuing the business, because someone might come to the party, all of a sudden you might be able to raise money, but you can't raise enough money to pay creditors in full. There's a procedure in terms of the Companies Act, Section 155, where you can apply to court to do a scheme of arrangement, an offer of compromise with creditors. And to achieve this, you need the three different classes of creditors to vote at separate meetings. So it's not like a business rescue where you'll have just one meeting for all the classes of creditors. Here, to get a scheme approved by the court. So for example, to give creditors a haircut, but you've raised money to continue, provided you can compromise with creditors through a formal scheme of arrangement like this, you'd have to have 3 different meetings of creditors of secured, preference, concurrent, and 75% in value, and a majority number of each different class of creditor must vote in favor of the scheme to get it sanctioned. So you've now got to consider either an informal compromise by speaking to your major creditors in the hope that everybody will accept, 100% of all creditors will accept some compromise. That's the informal route. But you've got to remember that with the informal route, once you make that approach, any creditor can apply for your liquidation if they are unhappy. If that can't work on an informal basis, you've then, if it's possible, got to consider business rescue, or you've got to go for a liquidation if business rescue, after you've done a pre-assessment, is not possible. Those are the options that you've got. Time is a very, very important factor here. You've got to catch it early, because when you catch it early, there are a lot of alternatives. You may be able to get the business into a state where you can look for somebody to inject capital. You might be able to convert certain debt to equity. There are ways that you can restructure the business, but time is of the essence. The sooner one does it, the better. And once you get a professional like an accountant, like a person like Lance who specializes in restructuring, or an attorney involved early, the prospects of success are far greater. The big problem comes in delaying the decision. And you know, one can understand it. People delay the decisions because it's very emotional. And also the main thing is they think that tomorrow will be a better day. You'll be able to trade out of it. And more likely than not, it's very difficult to trade out of a bad situation. And one has to consider whether the business in its existing format is capable of being turned around. That's another thing that's very important, is a turnaround strategy, because maybe the level of debt, for example, is too high. That if you can get that level of debt down, you might have a successful business. All these issues have to be considered very early, because the longer you leave it, the more the business or the company loses credibility with creditors. As soon as you stop paying people, it creates a problem. You know, creditors speak to one another, and it's very hard afterwards, once you've incurred more credit, when you couldn't pay creditors, you keep on trading, to then try and persuade creditors that they should support you if you need to get a compromise with those creditors. Business rescue, I'm not in favor of, unless you've done a pre-assessment beforehand and you know that there is a reasonable prospect and you have funds available. I don't like using business rescue as a tool just to delay the payment to creditors when there's a possibility that you're not going to be able to conclude a successful business rescue, because then going forward, it's going to be more difficult for you. If you decide to open up a new business or get credits in another business from creditors that unfortunately never got paid, what you have to realize is liquidation is not a crime. It's not a crime to go into liquidation if you have to. And if business rescue won't work, it's far better to put the company into liquidation than have all the headaches that can result from a business rescue. You know, you must also realize that in a business rescue, the company doesn't die. It still continues. And the business rescue practitioner will still have to engage with you. You still retain your shares and everything. And until that process is complete, it can be very stressful. Whereas in a liquidation, it's far different when a liquidator is involved just to wind up the company. Lance, do you think there's anything else we need to say about the different processes that is important?
No, Paul, I think you've concluded well there. I think, like you said, we could continue explaining each of the processes for a very long time. Again, just want to highlight timing again, absolutely critical. Having a look, getting an independent party in, doing it internally with your accountants to have a look at the business and just to understand the options available. Because to Paul's point, the longer you leave it, the less options you have. And you don't want to be in a situation where, and often we see this, is companies are going into business rescue where they feel that's the option. And it's just too late. It really is too late. And the companies essentially should have been going into liquidation. and you are now left with that drama, as Paul is saying, with the admin of a business rescue, converting it ultimately into a liquidation. And you want to try and avoid that. You want to be able to look at a company, and I agree with Paul, our company really only takes matters on where there is a pre-assessment that has been done and post-commencement funding available, as well as there being a reasonable prospect of a business rescue being a success. So absolutely, Paul, I think we've touched on the options available, and happy to take questions.
Paul, Lance, thank you so much. Thank you for really clarifying the difference and providing the audience today with a really deep and full, concise understanding of all the steps involved towards a business rescue versus liquidation. I know that Philip had a question that he posted earlier. Philip, would you like to unmute yourself and ask your question?
Excuse me. You, I think it was you, Lance, who addressed used EdCon as a benchmark for some of you for a restructuring or liquidation that you did there. And my question to you is, how do you extrapolate that for SMEs and smaller businesses, that same process to get them back into into an operating position, because the differences are so glaring?
Yes, I think with that, business rescue costs money. I think it is an expensive process. You've got practitioners' fees, you've got legal fees, and again, just around the cash flow impact of going into business rescue. Obviously, the smaller the company, the lower the rates in terms of a tariff-based fee situation from a practitioner point of view. So that reduces it slightly. But I think, some businesses may be too small. It could be just too expensive, and maybe in that instance, a smaller business can look at an informal restructure. But I think that there's certainly a place the Companies Act provides for small, medium, and large businesses going into business rescue. So it's definitely a tool that can be used. And if there are same issues and similar issues, sorry, I don't know if I'm understanding your question entirely correctly, so apologies. You should be able to use the tools that are available to you within the Companies Act and the Business Rescue to restructure a business any size.
So let me put it to you this way. An SME can be a one-man person, can be a two-man person. It's not an Anglo-American or an EdCon. How do the processes of restructuring, rescue, etc., follow through using EdCon as a benchmark?
So I think the same process would take place in terms of doing a pre-assessment. I think it's important to look at the options available. And I think looking at each business individually, I mean, they all come with their own nuances and issues. And so I think looking at the options in terms of an informal situation, what a business rescue could look like and what a liquidation would look like ultimately for all stakeholders is something that can be done.
Okay, thank you. One more question that I just posted as we're nearing the end of this. I recently saw on the internet, and it was purely by default, that if a company, and it might even be a bigger legal issue, has got a batch of invoices that clients have not paid, irrespective of value, you can actually sell these invoices to, I don't know what you call them, an investor of some sort or another. I'm not sure what the correct term is yet. And you get paid by that person or organization, and they then go to the credit the debtors and get their money back from them. Now, obviously, there are legalities involved. Do you know what's involved in it, what that kind of process costs?
Well, if I can answer that question.
Okay, thank you, Paul.
You know, to discount invoices has been going on for years. You can either do it where you've got a factoring arrangement where you offer all invoices to the factoring house. You can also have a deal where you only are discounting specific invoices. And what happens is that the discount that is applied by the person who's prepared to buy the invoices varies depending on the risk, what type of company you're going to discount for, what is the nature of the debtors, how long have the debtors not paid for. You got to, they look at the age analysis and everything, but it varies. I'd say it can be anything from 15% to 40%. The discount that you'd have to take in disposing of those invoices.
In other words, just interrupting you there, Paul, you're saying that if for example, the invoice, the file of invoices is worth 100,000, you take 40,000, you take 40%, 15 or 20% or whatever off as a discount.
Correct.
Okay.
I'll never buy those invoices at face value.
And that irrespective of the period involved, 30 days, 60 days?
Period's important. The discount would be less if it's a new debt. Whereas if those invoices haven't been paid for months, the discount will be much higher.
Why would that make a difference?
Because if they haven't been paid for months, it could mean that the debtor itself is experiencing financial difficulty.
But where they ask you for, where for example, and I'm sitting with that particular situation, I'm a small one-man business, but these clients have asked me in the early days, within 7 days or so of the invoices being issued to them, turned around and said they want a revocation of debt, and I said absolutely not.
And also, the amount of discount depends on whether there's a right of recourse against the company who's selling the debt. And how strong is that right of recourse? In other words, is the creditor who is disposing of the debts strong enough to meet any possible claim if the debtor doesn't pay?
Okay.
So you've got to take all the different factors into account to then work out what your discount's going to be. I mean, if you're discounting debtors that are only 30 days old and very strong debtors, the discount's going to be far less than the discount when your debtors are much older and where there's a history of the debtors not paying.
See, the all is paid on within 7 days of invoice. All is paid within 7 days.
And are the debtors strong?
Reasonably.
Well, then your discount should be far less. And will there be a right of recourse against the company if the debt isn't paid?
You see, that's what I want to find out, because I don't know. I'd like to try and, as far as possible, protect myself.
Yeah, you know, Philip, when you're analyzing this sort of thing, and you're the person who's going to be selling the invoices, it's far better to possibly take a greater discount on the invoice and know there's no right of recourse against you. Otherwise, you've got no certainty.
Okay, thank you. Thank you very much, Paul. Thank you very much, Lance.
Are
Are
there
there
any
any
other questions before we end off today? I think, Paul, Lance, you have given every single participant on this call so much food for thought, and the way that you have both presented and explained everything so eloquently and in a simplified manner for us to understand has been absolutely amazing. On behalf of myself, Helene, and the AutoJet team, it's really been an absolute honor to have you on our Zoom platform this morning. And we definitely hope to welcome you both back again really soon. The value has been incredible, not only for the AutoJet businesses, but I see a number of mentors joined us too this morning. So we're so grateful to you for your time, for sharing your expertise and knowledge, and we look forward to working with you both again soon. Before we close off today, we are going to put up one more donation poll. If anyone did not have the opportunity to donate earlier and would still like to, now is your opportunity. So please feel free to click on a button and submit. And Philip, I'm looking at your face. Lance and Paul, thank you so much. I'm sure Helene will want to thank you as well before we close off today. Your time, we cannot put a value on it. And we're so grateful to you both for giving up your time today to do this for us. We wish everyone else.
Absolute pleasure, really.
Absolute pleasure. Thank you, Tracy. Tracy, I see Shauna sent me a private question. Shauna, can I touch base? I'll have your contact details. I'll touch base with you offline if that's okay.
I will give you, I don't know if she's put her details in the chat to you. So Shauna, you can speak to me. I'm happy to facilitate it. And to everybody else, thank you so much. We hope that you all gained the value that you anticipated at the onset of this webinar. Paul, you're such a gentleman. What a pleasure. Lance, you too. It's been an incredible just over an hour, and I will definitely be in contact with you both again for something for AutoJet. Thank you for the support you've given us.
Thank you, Tracy.